Okay, we're going to do a little class here, guys. All right, my name is Christopher Terry, CEO of iMarkets Live. We're doing a little class here for our live trading room, and we got a packed room here today, and we are rocking and rolling. So, I want to talk a little bit about balance. The markets always want to be in balance. As you see here, we can go back in time. Okay, we can go back in time, and we're going to draw on the screen a little bit. We're going to do all sorts of different things. So let's go back. The market sells off, has a sharp move down of 20 points. You see this? Okay, in 5 hours that went down 20 points. Well, the market's had a big move. Let's look at this as you running uh, a quarter mile, okay, or a half a mile. If you're me, 5 steps. You need to rest, okay? So you run as hard as you could and then you rest. So the market, it rests. The markets always want to be in balance. They love balance, okay? Let me just put these. I'm going to be drawing, so if I'm making a little mess with the drawing tools, just forgive it, okay? So the markets love to be in balance. The market's comfortable right here. See, the market's not comfortable here. You got to picture the market when you are like this, where there's no balance, like those birds downstairs. They're about to get some balance into a pressure cooker. So I'm only kidding. They're cute little birds. So the market likes balance. So this right here, picture yourself in the rain. You're walking and it starts raining. You got to get to a safe place. So you get to a safe place and you're staying there while it's raining. You're comfortable, right? You're comfortable. You're in a safe place. The market feels safe in balance. All right? It feels safe there. It just doesn't want to leave. It just loves to be in balance. Everybody's buying and selling. We're all together. Kumbaya. That's the market. All right? Everybody's safe. And it becomes this little sort of a tug of war. Okay? Buyers and sellers go into this tug of war. And you know what happens. When one side tips, everybody falls into the water. And when the buyers came in, it took it out of balance. The market went out of all the buyers. You got to figure, let's just say uh, you had 50-50 here, and now it's 80-20 on the upside, buyers. And the market then rests a little bit. But the guys who didn't get in here are now wanting to get in here. So they all start buying again. Okay? The market's looking for balance again. It's now imbalance. It's out of balance. Imbalance, out of balance. That's why you get big moves when it comes out of balance. When the market comes out of balance, that's where big moves come from. So now the fact they jumped up real hard, they went from 30 to 45. Look at this right here, right? 20 points down, it went 15 points up. Market's out of balance. It basically said we're going higher. In here is where you got everybody trying to buy the breakout and they're getting trapped. And they're getting trapped. And they're in here trying to fight and trade. These are the little guys trying to pick a direction. And then when it goes up, they think they were right. Or if it goes down, oh man, I knew it. So you wait. The market gets out of balance. And then you got that little pullback, and you see how it tests that prior area, that balance area. Okay? This is also called value. They have a thing called value area where they take 70% of the range and that becomes the point of control. So right here, this is that point of control. Okay, so as long as if you're buying this right here, your stop would be below the point of control. Because sometimes you could have a deeper pullback. But the fact is, the market tried to go back into balance, but there was too many buyers. Everybody's already committed to the upside. You got everybody buying They now start buying again because they realize market's out of balance. It's away from the middle of the zone. We're not coming back. And all the buyers jump up. Bang. And they run it up 30 points. These are the bigger players. These are the banks. These are the bigger traders, funds, big, big money, not the little guys. Guys like, little nickel dime guys, one contract guys are not making it. We're talking thousands and thousands and thousands of contracts coming into the market and just moving that market. Okay? So after the market runs, what does it do? It rests. Okay? And this is where all the little guys are buying. They're buying the pullback, right? They missed the whole move, but they're buying the pullback, and the bigger traders are just sitting back. And what happens? The market goes again into balance. It goes into balance. Watch this. 1, 2, 3, 4, 5 is normally your range, your triangle. 3/4 into it, it comes out again. Breaking out of balance. The market's now out of balance. The market is like that cat. That if you take a cat, you throw him in a bucket of water, throw him in the middle of the street, he's going to flip out and go under a car. He's finding protection. Okay, I know it's not really a great analogy, but it's dramatic, right? It's dramatic. And the market gives its reaction up, but it's already completed. It's already completed balance. It's now out of balance. It was comfortable here. Okay, the market was comfortable there. It's comfortable. It's relaxed. It's at the beach. No hurry, no worry, retired, relaxed. Okay, that's the thinking that the market does. And now it's out of balance. You get a little reaction up and flush once again. The professionals are catching these moves. The little guys are buying up here and they're getting trapped. The little guys are selling here. The bigger guys come in. Okay? The little guys are getting trapped. They're buying, they're trying to buy here for the breakout up. They get stopped, they buy, and they get tired. And the bigger traders come in, bigger money comes in and says, you know what? We're going to rush them to the downside. So when you hear the term price action on the internet, I'm showing you what price action is. Okay, this is price action. You want to also look at the relationships of these past moves, right? So if we were to take a Fibonacci and we take a look at the length of this last move, I'm sure this would go in at 100% or 75%. So you see this? Watch. Let's get rid of all this other jibber jabber, jibber jabber, jibber jabber. Okay? So right here, we just copy and paste it. And you see market came out of balance. You now have, and I'm sorry for doing this, okay? You now have two things. You now have swing high here and a swing high here that's basically 100% of that prior swing. This is what's called alternate wave equality. Okay, looks like this. Up, down, up. Alternate wave equality. This is an alternate wave. This is a primary wave, initiative or impulsive, and you got alternate wave. Okay, alternate. So markets love a couple of things. I'm taking you through a journey of the market, okay? Markets love a couple of things. Number one, they like relating. They like relating. They like being in love. I love you. Last move was 10 points. I love you. I'm going to go 10 points also. It comes down. Okay? That's a resistance up here, right? We see it. You see how this came down and back up? That's called a test. That's called a test, a retest. When you have when you have a situation like this, and it hits there, this is called a test. This is a test. This is a retest. This is a retest or a test of a low. Test of lows, a retest of a low. Okay, and that's all that did. This was testing that 100% of the prior move. All right, it's that alternate wave equality. Gann said, or was it Elliott? Doesn't matter. Markets will relate in degree. So since this is a 5-minute chart, it's a 5-minute chart. We could look at time. Sometimes time is the same, it's different. But price, yes. So it came back down here. Once again, I love you. It attracts. Markets attract. They attract to what's safe, okay? What's safe, what's known. They attract to that. They attract to highs. They attract to the lows. They attract to balance. So if you guys look what I'm drawing in as we're doing this, what am I drawing in? A whole balance zone, right? A whole zone for balance. The market is happy in here. It's in balance. All right? It's in balance. It's happy. It broke down and now it's made its lows and it's going through its process. Worked all the way back up here to relate to the prior swing. Tried to push up a couple of times because the market's on its way down. You have all this structure above and then it works its way lower. And then look, okay, let's look even further. Let's look even further. Let's draw a horizontal line here and a horizontal line there. What do we have here? Balance. Balance, right? The market's in balance down here. See this? Market went sideways. Balance. Held the lows. Held them. And then went sideways. It's in balance again. It's comfortable. It's in a range. It's comfortable. All right? And then it started to break out of balance. Break out of balance. Getting your pullback. Testing upper end of balance again. Okay, coming back in. It's not ready. This is all balanced. The market's comfortable. And the moment it breaks out and gets some momentum, all the buyers, all right, all the buyers were already getting in down here. We see that. We see how the accumulation was down here. This is all accumulation. Market rallied. This is all accumulation down here. You see how sideways the market was in balance. And now it broke out to the upside. And what happened once it broke out to the upside? All right, we broke out to the upside. And what happened? Market goes into balance again. Okay, expansion, contraction. Expansion, contraction. That's what the market does. Expansion, contraction. Okay? You guys with me? All right? This is what the market does. Market expands. It goes long way, sideways enough. It creates that value. And we start breaking out again. We start breaking out again. All right? You get that pullback. The first pullback is always the best pullback out of a range. The first pullback is always the best pullback. All right? Then what happens? Market does it again. Balance. And this was at the federal FOMC yesterday. FOMC yesterday, right? Sideways line. All right? Sideways line. So, FOMC, market gaps all the way up out of FOMC. All right. Now, when you have price, when price um, has a shock, a very large move, okay, something like you have with the FOMC, or this would be equivalent of an opening gap at the 9:30 open at stocks, a big, huge gap. And a lot of stock traders take those and they run with them. What they do is they take the first half hour of the day and they run with it. But one thing we know, when there's a large gap to one side, there's going to be a trend off of that in either direction. So it's just a matter of waiting to see where the impulse is. So you went out of balance to the upside. That move was made, okay? But this became a whole new game after the 2 o'clock time frame. There was a shock in the market, right? Everybody was expecting uh, some to do with interest rates. They did something else. They said something else. And the fact is, the market got up here, and here's what happened. The big money people rushed it up. All the little guys came in and bought the pullback. And all the big money already out. They said they weren't raising interest rates. Wow, positive, run, run. Everybody's buying, right? And all the big people are selling it to them. And there was nobody left. No big money to buy because the interest rate's not going up. Maybe it is a negative. Maybe not raising interest rates is a negative to say there's something wrong out there. Because think about it. If there's something really right, the market should be able to raise interest rates. Number one, to help get people money on the interest. Number two, it'll stabilize. Right now we're at all-time lows. So them not doing it, maybe it turned out to be a negative. I don't read into that stuff. I don't know about that. I'll be honest with you. I'm the last person to ask. But the fact is how it was perceived is all we care about. So market was out of balance, right? Market went back to balance and it literally failed. So there's a saying, when it comes out of one side of the box, comes back through the outside of the box, that's where the trend is going to go. And that's essentially what happened. So if we look at the market here, we look at the lows of this whole range, we look at the better part of the value, 70, lower end of 70% is all value here. We can see that the market wanted to come back up, test it, and you could see the market did what? It broke down and corrected up. And what did it do? It went back into balance. All right. Market went back into balance, sideways, back into balance. It just had a huge move. Everybody's resting. Everybody's resting. And here's what happens. All the big players, they're resting. All the little players, they're trying to buy it. You could just see, right? All these little bumps here are people trying to buy it. That's not big money. That's little money. Big money here is saying, no, 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 you're not going up. We already drove you down. We're short from here. We're short from here. We're short from here. You're not going back up because we're in control. We are the sellers. We're in control. And all the little money's trying to push it up. And the bigger money came back in and says, no problem. Crashola. We're going to trap each and every one of you in here that have been trying to buy. We're just going to trap you to the downside. So if you look past our little timeline here, markets love balance, going in and out of balance. This morning, we saw the market flush to the downside, and now it's trying to correct itself up. So what we did this morning, let's look again, okay? This is a 1-minute chart, all right? This is a 1-minute chart. This is resistance. All right, so we were looking this morning. The market was going sideways. Whoever was with us this morning at the open, all right, what was I saying? What were we saying down here? Any little push down, we want to buy them. We want to buy them. We want to buy them. but the market jumped up too fast. We said, you know what? It left us in the dust. It left us in the dust. Then it came up here. We looked at the short side, and then it came back up and held. And then I think we looked at the long side a little bit. And on the pullback down, we looked at the long side. Remember, it was holding. Then it went up. And then when it came back right through, and it's created this balance, okay? See what I'm doing, guys? I'm bringing you right the storyline of what we did this morning. It went into balance again. It went into balance. And soon as that market said, you know what? I don't want to go up. I'm coming back down. We shorted this reaction up. Short, 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 right? Short, short. Put your stop up here. Short, short, short. And boom, bang. On the way down, we exited parts. We exited the balance on the way down. And you catch yourself a really nice move. This is about 6 to 7 points overall. There's enough money for you to grab. And that was it. You didn't need to do much else. All right? That was it. Market came off this little balance. We wanted to go long. Unfortunately, it ran first, came back up, and we were watching to see if the first balance wanted to take us a lot higher or not. They ended up going sideways. They ended up pushing up. As soon as they came back down, we realized they're not going up. They're faking out to the upside. They're faking out to the upside. So we shorted with all the big players. We went with the money. And we took it down right to our balancing point down here. And that was it. We have our balancing points. They work. They're great. They're phenomenal. And that's it. Like right here, most likely you'll see a little bit of a support. Okay? Why? This is all balance in here. Okay, let's watch. Let's look at this. This is all balance in here. All balance right there. So the market knows that this is the past. This is already balance. This wants to come down and it's going to bounce a little bit. All right? It's normal. It's going to do this. It's going to go. It's going to do that. All right? So you can take advantage of these markets all day long. You just have to know where balance is, where expansion is, where the market's imbalance. Imbalance, out of balance. Imbalance, out of balance. Okay? It's all about being in balance and out of balance. When they're in balance, you don't want to be in that. You want it where the market is out of balance. That's where the big money comes from. The market being out of balance, not in balance. All right? That's where you want it. Like right now, the market's coming back to a balance area. You don't want to, you can start scalping on long side. Let's not do it. We're not doing anything anymore. We already made our money. But the point is, you can't get this anywhere. All right? All these people on the internet, they're teaching us stupid indicators. Okay? So, market's in balance, out of balance. So what did we do? All right? What did we do today? We did real good here. So, let me just all right, let me just show you something. Got guys in the room making. Trish made $300 and something today. Tim made this much for the week because he was up 200 for the week. This is a $3,500 to $5,000 number. $3,500 to $5,000 account number gives you that much. Tim, am I right? Tim, am I right? Roughly. Okay, right? Okay, let's get that out of the way. I'm sorry. So anyway, you're getting a market now that's coming back into balance. It doesn't want to be there. It's not. This is all support in here. So we're pretty much going to complete this little class here. But I just wanted to bring to your attention markets in balance, markets out of balance. Where's the money made? Money's made when the market's out of balance, not when the market's in balance, when the market's relaxed. You have to think about this. You're laying on the couch. You're laying on the couch. 4 days, not 5. Nice. You're laying on the couch. You can't have much activity. But when you're up and you're at him, you're a boxer in the ring. You're out of balance. You got your opponent out of balance. That's they say the first dog that attacks wins. Why? Out of balance. All right. So let's conclude this class. We went for about 25 minutes, and we'll save it, put it up on the website.